Good morning, everyone. Welcome to the Macro Snapshot. We are Friday, September the 12th, 2025, recording this in the morning, as always. Let's just have a quick look and see what happened yesterday in Europe. Quite interesting ECB meeting. It was a little bit more sort of exciting than perhaps anticipated. And essentially, the statement seemed to be relatively sort of dovish. So initially, there was a bit of a rally. But subsequently in the press conference, Christine Lagarde, head of the ECB, of course, she made a couple of comments, and I've just got a couple of quotes here, which the market interpreted as a slightly hawkish kind of tilt. And one of the comments she said was that the disinflationary process in the European Union, or the Eurozone, is now over. So the disinflation process. So essentially saying that inflation has come back down to sort of some kind of basing level, and that there was a risk that it could even maybe not accelerate, but it could sort of rise slowly. And she also said that the balance of risks was kind of even. So essentially saying that the economy could sort of grow a little bit more, and that inflation potentially could rise a little bit more. Not in so many words, but the market interpreted that as saying that as Christine Lagarde saying that essentially they were fairly comfortable where they were in terms of the rate path, and probably there aren't going to be too many more sort of rate cuts coming in the future. So if we actually just go and have a look at where we're at with the ECB, you can see here that what's priced in if we go all the way out to next summer. So let's say the meeting in July 2026, even all the way out there, we've only got about 35-38% chance of a cut. So not even a full chance of the cut priced in. And in terms of basis points, we only have 9 basis points of cuts priced in. So as you can see, very different to the Fed. Essentially, the market seems to be agreeing with Lagarde and the Governing Council of the ECB that they're done for the moment. This lower bound of around about 2% for the deposit rate is probably going to be where they're going to stay. And if anything, they could hike at some point, if growth picks up. Now, no one's saying they're going to hike, but it does seem that they are in a plateau kind of situation for the moment. Now, in terms of just the Euribors, which is the 3-month short-term bonds, kind of like the SOFRs in the US, approximately, you can see here just compared to 1 week ago. So 1 week ago is the implied yield you see here in the orange, and you can see that the live data, so this is what's happened over the last few days here. You can see here on the white just that all across the board, more or less, the implied yield has gone up. So especially in sort of the March, June of 2026, you can see here that there was a rise in yields over the last week of about 5 or 6 basis points in the implied rate. So essentially, what the market took away from the ECB yesterday is that inflation has come down significantly. Probably it's not going to come down too much. We'll kind of reach the base. Growth seems to be sort of okay. There isn't even a possibility that it may pick up over the next 12 months or so, and that the ECB is in absolutely no rush to be cutting interest rates. So in terms of the German curve, we actually had some quite interesting and some quite strong reactions in the German curve, a little bit different to what happened over in the US yesterday on the back of some of that data. But if we actually look here, we can see here, just look at the difference here. So this is the 2-year yield in Germany. Sorry, that's the 3-minute chart. We don't want that. Let's put it on the daily chart. So if you have a look here, you can see here that the 2-year yield actually yesterday had quite a push upwards, and even today is still rising a little bit above the 200-day moving average. It's kind of interesting. It's pushing up high. So you see at the front end, the yields really sort of actually pushed up quite a lot. But now compare this to, let's say, the 10, which you see has gone up. Yesterday didn't go up at all. Today it's up a bit. And then let's say, for example, the 30. So look at that. So we'll go back to the 2. You can see a very strong push up in the yields compared to the 30, which, as you can see, has actually been sort of falling downwards. So we had a pretty big sort of flattener. If we can look at the curve here, I'll see if I've got my German curves up. So this is the German 2s to 30s. You can see a big sort of bull flattening here. And essentially what's going on here is that, the market is pricing out any possibility of a cut at the front end, so pushing up those yields. And by doing that, that's signaling that the ECB is going to be fairly tough on inflation and is in no mood to sort of cut. And that's actually sort of good news for the back end of the curve, which hates inflation, of course. So a pretty strong sort of bull flattening over in Germany. And you can see that we're getting to a level which I'll just update here. You see we're getting to quite an interesting level. And to be honest, that's an attractive target down to about 1.2% here. Let's see if it gets all the way down there. But definitely some a sort of flattening happening over in Europe. What's also interesting is that as these yields are going up in the front end in Germany and potentially coming down in the US, we're seeing that the differentials here. Let's have a look at these differentials. You can see the differentials here. So this is the US 2-year yield. Subtract the German 2-year yield. And what we can see here is that this has been really an ongoing process for, basically a month or so, uh, even more, maybe like 6 weeks or so. And you can see yesterday even more sort of tightening of that spread. So this is getting closer and closer together. So that's saying that the US here is yielding on the 2-year only about 1.5% more than the German, its German cousin. And you have to ask yourself, if that continues to happen, let's also look at, let's say, like the 5-year. Similar kind of situation, and in the 10-year as well. So all across the curve in Germany, those yields, the differentials with the US, so the US yields are sort of, if anything, coming down, and the German yields are going up a little bit. So those yields are compacting. And you'd have to say that in terms of the euro, this should be, in theory, a bit of a headwind for the euro. Now, obviously, that's going to depend on the US dollar, but it does seem here that the euro is grinding upwards, and it would not surprise me at all if the euro does test the top of the range, maybe at 118, and even pushes quite a bit higher. Because on the other hand, of course, we have the Fed meeting next week, and the idea here is that the Fed, the market at least, is fully pricing in a sort of a cut. So we're starting to get quite a significant divergence in terms of central bank policy, potentially between the Fed and the ECB. As I just said, the ECB seems to be pretty much on hold for the short term, whereas the Fed, as we can see here, for the upcoming September meeting next Wednesday, it's fully priced in one cut. We've got 26 basis points, but not only that, compared to the ECB, look at this, two cuts. 2.8 cuts then by the Christmas meeting, by sort of December meeting. So essentially what a lot of market participants are saying, a lot of analysts, does seem to be that, a lot of people are saying either we'll get a jumbo cut next week. I don't think they're going to go for a jumbo cut myself. I think, it's more realistic to think about, cutting in, September, October, and maybe December. So at least, 2 to 3 cuts this year, then maybe even another, a fourth, fifth, sixth cut even going into next year, depending on how the economy holds up. So the point is there is a bit of a divergence happening that would argue for, potential trades could be something like sort of, long the 2-year in the US versus shorting the Schatz, the 2-year in Germany. Obviously for the currency, something like the euro. And if you look at something like sort of Canada, I was looking at some data this morning on Canada, the Canadian economy does seem to be weakening. So something, maybe like shorting Canada along the euro could be an interesting trade. Let's have a look at that chart. I'm not sure exactly where we are today, but as you can see, that has been sort of an ongoing sort of trend, and it looks as though that may continue because Canada, for example, seems to be suffering, and it looks as though the European economy is doing okay, and that their central bank, the ECB, is not planning to, as I said, cut anytime soon. So interesting to start looking out about sort of some cross pairs with the euro. Especially, maybe against the US, but also some of the weaker sort of economies around there. Now, in terms of the US, yesterday we did get some interesting data. We got the CPI. Now, remember on the day before, on when was that? So I guess a Wednesday, we had the PPI, which was pretty weak. And if we actually look yesterday at the CPI, it was kind of a mixed data. If we look at what was clearly a little bit dovish, we had initial jobless claims at 263,000. So that's the worst it's been for quite a long time. And the market jumped on that. So that was really the market's focus, because the market now believes that the Fed is, in terms of their twin mandate, is really focused on the employment data. And so that really got the market's attention, that 263,000, as an indication of potentially a weakening US labor market. But having said that, the market sort of looked at the data, and it seemed that, a lot of that was driven by, pretty bad numbers coming out of Texas. And there was some idea that maybe that was to do with sort of some, some sort of environmental, sort of some weather events down there. And maybe it was like an idiosyncratic thing. Also, the week of the data was in Labor Day. It was taken in the Labor Day holiday. So maybe it was a bit skewed. So maybe the point is that maybe this number is a bit of an outlier and a little bit of a statistical oddity, and we shouldn't overread into it. Because if you look at the continuing claims, that actually came down a little bit, not much, but it didn't sort of rise. So, but the market did immediately latch onto that initial claims number, which, is going up. And if you look at the average For the 4-week moving average now at 240,000, going up from 231. So for sure, you can make an argument that, it does seem as though that particular metric is weakening. Although, as I say, there are some caveats with, Texas and Labor Day and whatnot. But then if we actually look at the CPI, it sort of came in more or less in line. But a lot of the increases you see here, though, the headline number actually increased from zero point 0.2 to zero point 0.4, which was above expectations. If you look at the core number, that was sort of in line at zero point 0.3, although I believe the unrounded was 0.34. So that was pretty close to being zero point 0.4 as well. But if we actually dig into that, we can see that a lot of the increases came in things like sort of airline fares, used cars, shelter, food, energy. So the point being that if you look at core goods, that only rose 0.1%. So if we just turn our attention back to the tariffs, what that's basically saying is that, all of the core goods which are being, or the goods which are being imported into the US, not really showing much sort of inflationary pressure. So does that mean that companies are not passing on the sort of the tariff prices? Is that because they don't believe they can, or they don't want to, they want more clarity, or they believe that the consumer is unable to kind of absorb that? And that means that the profit margin for a lot of companies may be increasingly sort of squeezed over the next few months as they, potentially elect not to pass on the tariff costs, and basically have to eat a little bit of a profit margin. And we saw that echoing what we saw in the PPI numbers on Wednesday in the so-called trade services category, which was fairly contained. And that's essentially a proxy for sort of profit margin. So the point is that let's keep an eye on all of that, because if the profit margins are being squeezed, companies are unwilling or perhaps unable to pass on those increased costs coming from tariffs, at a certain point that might start affecting sort of earnings and obviously then the stock market. But what also was interesting in terms of the data yesterday was the real average, the real average weekly earnings. So as you can see here, 0.4 down from a prior of 1.4. So that's interesting here. That is certainly, you could argue that's a bit deflationary, average weekly earnings going down, and could also indicate that the labor market is definitely not tight, and that employers are starting to gain the upper hand in terms of wages over employees. Interesting there. So that could be a little bit of something. And so it looks as though yesterday the market, in the US at least, sort of seized on this number here as being a bit deflationary. Headline numbers. I think the market's basically saying the Fed's going to cut, and we don't really care unless it's sort of crazy bad. Now, today we do get a little bit of survey. Again, this seems to be politically oriented, depending on the respondent. But nonetheless, we do have University of Michigan. We have the first numbers, the preliminary read for September here. Let's keep an eye on the inflation expectations and also just general sort of sentiment. I don't think that's going to be supermarket moving, but it's part of the mix. In terms of some other stuff, just looking, we do have for the French bonds, we have the Fitch upgrade. Now, Fitch hasn't sort of looked at France since March. That was the last sort of review. But basically, if we go just have a look at the French bonds, let me just bring them up. If we look at the FOAT here, it's possible that there is going to be sort of a downgrade. We'll get that information after the market close. And you can see here that, it did bounce, the French bonds did bounce off this sort of level here, this sort of triple bottom here. But as you can see overnight and going into this morning session, they've come down. This is the price, not the yield. They've come down quite a lot. And maybe that's an anticipation of a potential downgrade by Fitch today of the credit quality of France, which is expected. That wouldn't be unexpected, but for sure it's not a positive development, and it would not surprise me at all as we start to see the yields climb in Europe a bit if maybe the French bond is one of the worst performers, or sort of underperforms, let's say, the Italian and the German bonds, and we could be sort of pushing down to this 120.50 level again. And also let's keep an eye here on the spreads. As you can see, it was contained at about 82 basis points, but it would not surprise me as well if that starts to push up there a little bit as well. So that's about it. Just one other thing I just wanted to have a quick look at is just looking here at the dollar And actually, look at the dollar here. So you can see here the dollar remains fairly much range bound, but it is trading heavy, as we say. Look, if you see here, it's finding it difficult to get above the 50-day and even the 20-day moving average here. It does seem to be just sort of slowly grinding downwards. And if we, and even sort of the slightly sort of higher yields we got yesterday in the US didn't really help out that much. And it does seem that the general consensus here is for a slowly weakening U.S. economy, a slowly weakening employment situation in the U.S., and of course a Fed which probably is going to start a cutting cycle. And as we just saw, an ECB which in a certain sense seems to be slightly more hawkish. At least there's going to be some kind of divergence. So I do expect the dollar index here to at least test the bottom of this range, maybe 96.5 or so at a minimum. And it would not surprise me if over the next few weeks that does actually start to go down into this lower range, down towards 96 and eventually down to 95. Absolutely not surprising. Finally, just want to have a quick look at oil. Oil, again, just sort of bouncing off this looks like a pretty key level here, about 61.50, 61.60 or so on the WTI. Again, as I've been saying, not a huge amount of sort of energy in this market. It's in this sort of conflict between, sort of relatively flat global demand and sort of inventory over, sort of buildups in global inventories. On the other hand, we still have some geopolitical tensions with, the Russians, East Europe, Ukraine, Poland, and potentially the Middle East as well. But I just wanted to have a quick look at the spreads, just to see how we are, to sort of zoom out a little bit and just sort of see what the physical market is telling us. If we actually have a look here, let's just look at the curve. You can see here that it's still in a backwardated sense. Now the price has come down, but we're still in a fairly supportive backwardated curve here. So the front contracts are more expensive than for further out delivery. Although what is a bit weird or interesting about this curve is that you see the price does go quite a lot lower all the way through 2026 and then picks up into 2027. And that's relatively unusual, but it seems to be signaling that the market saying, okay, the physical market is relatively tight at the moment, but there could definitely be sort of some overproduction and some surplus and some building inventories globally as we go into 2026. And you see that price does fall off quite a lot then to kind of build up a little bit there. If we also look at, let's say, a sort of a time spread here, I've got CL1, CL6, so the prompt contract, the front contract versus 6 months out. And you can see here, if we look at the spread, these are the two individual prices up above here. But if you look at the spread here down below, this is an hourly, so 60-minute chart. You can see, it's not horrendous, but it is grinding down, getting closer and closer. So it does seem, at least on this particular time spread, we now have a differential of about 75 cents, that it is slightly weakening. So it could be that the physical market is slightly weakening, and that would make sense then for oil, just in terms of the outright price, just to be trading a little bit on the heavy side. Okay, guys, I'm going to leave it there. Not a huge amount of data. As I say, we do get some surveys from the University of Michigan. We have some ECB speakers out this morning, essentially just saying that policy seems to be in a good place. There's a conference over in Qatar with those regional players, sort of just trying to sort of understand the fallout from the Israeli attack on the Hamas leadership in Doha the other day. But unless there's something particular, I don't think that's going to particularly move the markets. And of course, let's look out for the French sort of bond evaluation from Fitch after the market today. Have a great day and have a great weekend, and we'll be back next week. Thank you.